Hello, still no one has joined. Hello, hi, good afternoon. Is my voice audible? Everyone, is my audio and video clear? Please let me know in the comment section. We'll just wait for another 2 to 3 minutes. Still no one has joined. Actually, I told the time at 2:45. So let's wait for another 2 to 3 minutes and we'll start the session. Please let me know whether my audio and video is clear. Is my audio clear? Clear? Yes. So we'll wait for one more minute and we'll start the today's session. So in the previous two sessions, we have actually covered three chapters, right? First chapter we have completed, the second chapter and the third chapter. So roughly around 20 marks discussion we have done, right? Now in the today's class, we'll be starting with discussion of fourth chapter, which is risk assessment and internal control. So here the standards like SA-315, SA-320, 330, 450, all the related standards, and also SA-265. All these standards we will be covering here in the today's class, and you can take the weightage of these chapter is 8 marks. Basically this fourth chapter and the 13th chapter, audit in an automated environment, basically in your ICA study material, these two will be given as a single chapter. But if you observe, in each and every attempt ICA will give at least one question, at least 4 marks question from this particular concept. That concept will be just 4 to 5 pages only, but for sure ICA will give that question in the examination every attempt. So what I have done, students, they are taking this particular concept, audit in automated environment, as choice. So in order to avoid that, I have given it as a separate chapter. For sure you will get 4 marks from this, in from this audit in automated environment. Understanding? So today we will not be covering 13th chapter, we will be covering 4th chapter. Clear? Yes. Shall we start our discussion? So chapter number 4, risk assessment and internal control. Which standards we will be covering here in this chapter? SA-315, right? Which deals with identifying and assessing risk of material misstatement through understanding the entity and its environment. What is this risk of material misstatement will be covering? Okay. Next, SA-320, which exclusively deals with materiality in an audit of financial statements. So how to calculate materiality, what is performance materiality, what is the difference between materiality and performance materiality, all those things we will be covering. And SA 330, so if you see, as per SA 315, you will identify risk of material misstatement. So you are not identifying the actual misstatement as per SA 315, you are just identifying the risk of material misstatement, right? Now, as per SA 330, for whatever the romum that you have identified in SA 315, for that romum you will design your responses. Responses are nothing but audit procedures. Your responses will be in the form of audit procedures. See, you have identified a risk. Knowing that there is a risk of material misstatement in a particular area, will you be silent? No. You will design your audit procedures so as to reduce that risk of material misstatement, right? So as per SA 330, you will design such audit procedures. What are the audit procedures? Types of audit procedures, this thing we will be discussing in SA 330. And after performing audit procedures as per SA 330, you will identify the actual misstatements, correct or not? By performing the audit procedures, you will identify actual misstatements. Now, once you have identified the misstatements, these misstatements has to be evaluated. Evaluation means whether this misstatement is huge or is this misstatement very less, that is whether this misstatement is material or this misstatement is immaterial. Is the misstatement present only in one area or will this affect many other areas? This is nothing but evaluating the misstatement that you have identified. So as per SA 450, you will evaluate the misstatements that you have identified by performing audit procedures as per say 330. Understanding? So there is a link between 315, 330 and 450. And of course, whether a misstatement is material or not, how will you know? As per SA 320, the concept of materiality is discussed, right? So all these four standards are related to each other. Understanding? Now, even SA 265, even SA 265 also we will be covering along with these standards. When I start discussion of SA 265, I will let you know why we are covering SA 265 also along with these standards in this chapter only. Getting it? Yes. So these are the 5 standards that we will be covering in this particular chapter, which are interrelated. All these 5 standards are related to each other. Okay, so after 330 it is 450 and next SA 265. Now let us start our discussion with SA 315, identifying and assessing risk of material misstatement. Before we start discussion of SA 315, we have to understand a particular term assertion. What is meant by assertion? First of all, who will make these assertions? Management will make these assertions. To whom these assertions are made? To auditor these assertions are made. Understanding? Just a second. Okay, sorry, someone was knocking the door. I just told them I'm quite busy. So auditor, to the auditor management will give assertion, right? Where these assertions will be present? In the financial statements, these assertions will be present. These assertions will be related to what? Related to account balances, related to class of transactions, also related to presentation and disclosure. Now let me take an example. Account balance, that means let's say for example fixed asset. Fixed asset is an account balance, right? Now management, by showing fixed asset as, let's say, 2 crore rupees in the financial statements, so what management will do? Management will prepare financial statements. There they have wrote fixed assets 2 crore rupees, and they will give these financial statements to the auditor, right? That means management is making a assertion to the auditor that whatever the value of fixed assets that it has shown in the financial statements, that is correct only. It has correctly valued the fixed assets. Such an assertion management is making. Next, if it is mentioning fixed assets 2 crores in the balance sheet, it means that management is making a assertion that management, that is company, is having right over that asset. Company is the owner of such assets. Such an assertion management is making. You will call it as the rights and obligation assertion. Next, if you are showing fixed assets 2 crores, you are also making a assertion to the auditor stating that all the fixed assets that belong to the company we have shown in the fixed assets in the balance sheet. We haven't missed any fixed asset. This is nothing but a completeness assertion. So like this you will make various assertions. You means management will make various assertions to the auditor in the financial statements. Okay, now management has made various assertions to the auditor. Whatever the assertions that the management makes, will all those assertions be true? Sometimes they will be true, sometimes there can also be mistakes in that assertions, right? Now the duty of the auditor is to find out whether there are whether the assertions made by the management are correct, or are there any misstatements in those assertions that the management has made. So that becomes the duty of the auditor. Of course in the auditor you will do that only. You will verify whether the assertions that the management has made are correct or not. Understanding? So understood what is meant by an assertion? So understanding the term assertion, representations by management either explicitly or otherwise that are embodied in the financial statements. These assertions will be with respect to class of transactions, that means with respect to P&L items. So occurrence assertion. Occurrence means, let's say management is showing sales in the profit and loss statement. That means management is making a assertion that sales which we are showing have actually occurred. Understanding? Next, completeness. So all the sales that has occurred, we have completely shown them in the P&L. Next, accuracy. So if a particular sale transaction has taken place at 100 rupees, we have shown 100 rupees only in the P&L. We have not overvalued or undervalued. Exact amount we have shown, that is accuracy. Next, cutoff assertion. Cutoff means only the sales or any transaction that has happened in the current year only we have recognized in the financials. If any transaction has happened in the previous year, that we haven't recognized in the current year, and also we haven't recognized the transactions of next year in the current year, that is known as the cutoff assertion. Management will make this assertion also. Next, classification. Classification means revenue items have been correctly classified as revenue, capital items has been correctly classified as capital, right? So like this, management is making assertion with respect to classification also. Next, assertions about account balances. So what assertions can be there with respect to account balances? Existence. So whatever the fixed assets, whatever the liabilities that the management has shown in the balance sheet, those fixed assets, those liabilities are actually present with the entity. So that is existence assertion. Next, rights and obligation. Management is having right over that asset. Management is having a obligation to pay particular liability, that is the rights and obligation assertion. Next, completeness. All the assets, all the liabilities we have shown. Valuation and allocation, again same, and here also same assertions will get repeated. Assertions about presentation and disclosure. Generally presentations and disclosures you will make in the notes to accounts. So assertions will be with respect to occurrence, completeness, classification and understandability, and accuracy and valuation. Again the same assertions will get repeated. So this is understanding with respect to assertion. Got it? Yes. Now we will move into discussion of audit risk. So what is meant by audit risk? Audit risk means the risk of giving inappropriate audit opinion. Inappropriate audit opinion. Now what is meant by inappropriate audit opinion? It can be of two types. First, there are misstatements in the financial statements. Okay, misstatements are there in the financial statements, but auditor, he has not identified the misstatements properly, and he is giving unmodified opinion. When there are misstatements in the financial statements, which type of opinion has to be given? Actually modified opinion has to be given, but auditor by mistake, by not properly verifying, he is giving a unmodified opinion. This is one type of inappropriate audit opinion, wrong audit opinion auditor is giving. Second situation, there are no misstatements in the financial statements. If there are no misstatements in the financial statements, auditor has to give unmodified opinion, correct or not? But by mistake, auditor is giving a modified opinion. This is also again wrong opinion auditor is giving here, right? So in these two situations, you will call it as the inappropriate audit opinion, but these two situations are not audit risk. If you observe, in the first situation, what is being affected? Efficiency is affected or effectiveness is affected? Here if you observe, effectiveness is affected. In the yesterday's class we have discussed what is meant by effectiveness. You are not able to achieve your goal, your objective is known as effectiveness. So in the first situation, effectiveness is being affected. Actually you have to identify these misstatements, but you are not able to identify misstatements, so it affects effectiveness. You are not achieving your goal. So only this first situation will be treated as audit risk. Second situation will not be treated as audit risk. Why? Because in the second situation it will affect efficiency. Why it will affect efficiency, sir? See, actually there are no misstatements in the financial statements, but auditor is arriving at a wrong opinion that there are misstatements, so I have to give modified opinion. Now will the management be silent? Management will say, array auditor, there are no misstatements in our financial statements, once you check properly. Like this management will tell to the auditor. Now auditor will have to again perform audit procedures to identify the actual situation. So actually there are no misstatements, right? So to identify the actual situation, auditor has to again perform audit procedures. That means additional time he is taking, additional resources he is allocating, but at the end of the day he will come to a conclusion that there are no misstatements and he will give he will give unmodified opinion, correct opinion. So this second situation is insignificant. It will only affect efficiency. So this will not be termed as audit risk. Only the first situation will be termed as audit risk. Understanding? So here you can add these words. Audit risk means risk of giving inappropriate audit opinion when there are misstatements in financial statements. That means only first situation will be considered as audit risk. Understood the meaning of the term audit risk? Let me know in the comment section. Risk of expressing an inappropriate audit opinion when there are material misstatements in the financial statements. Yes. So if you observe the same explanation, I have given it here. Okay. Yeah. Next, what is meant by risk of material misstatement? So let us now understand risk of material misstatement. So now we will derive it from the audit risk. So if you see, audit risk is a combination of three types of risk. One is inherent risk. What is meant by inherent risk? Let's say for example there is cash. Now if there is a cash, there is an inherent risk that cash is subjected to theft, correct or not? So the risk that is present by birth is known as inherent risk, provided there are no controls around it. So in case of cash, the inherent risk is that it might be subjected to theft. So let's say for example in the area of cash, the inherent risk is 50%. That means there is a 50% chance that the cash will be subjected to theft. Now knowing that there is an inherent risk in the area of cash, will you be silent? Will the management be silent? No. What will they do? They will implement internal controls like CC cameras. They will implement. Is CC camera an internal control? Yes. So they will implement CC cameras so as to reduce the inherent risk. But we have discussed previously, even after you implement internal controls, they cannot reduce or they cannot identify all the misstatements, correct or not? Because internal controls suffer from some limitations, inherent limitations. So even internal controls cannot detect all the misstatements. So the risk that internal controls cannot detect all the misstatements is known as a control risk. Okay. So control risk, knowing that there is an inherent risk, you have implemented internal controls, and those internal controls also not able to reduce complete risk, you will call that as a control risk. Now let's say for example the CC cameras that you have implemented were able to identify 75% of the misstatements. Okay, of the total inherent risk of 50%, 75% is reduced. Balance 25% is there na. Even internal controls are also not able to reduce. So here the control risk will be how much? 25%. Understanding? Because controls reduced 75% of the 50% inherent risk. Balance 25% of the 50% inherent risk is as it is there. So control risk will be 25%. Now if you calculate this, how much it becomes? 50% multiplied by 25%, it will be 12.5%. So this 12.5% is nothing but risk of material misstatement. Understanding? So risk of material misstatement is a combination of inherent risk and control risk. Now tell me, is risk of material misstatement in the hands of auditor? No, it is not in the hands of auditor. Why it is not in the hands of auditor? Because by the time auditor has come to the entity for doing the audit, already this inherent risk is there, and controls also management implemented. This control risk is also already there. So this combination of inherent and control risk, that is risk of material misstatement, is not there in the hands of auditor. Understanding? Now while starting the auditor will determine acceptable level of audit risk. That means if misstatements are till this level, I am okay, I am able to accept certain percentage of risk. So let's say for example, auditor has kept acceptable level of audit risk as 2%. So he is ready to take 2% of audit risk, because we have discussed in the first class itself, auditor cannot identify all the misstatements, right, because of inherent limitations of the audit. That's the reason why auditor will give only reasonable assurance but not absolute assurance. So auditor is ready to accept a level, a 2% of audit risk. Now this 12.5% risk of material misstatement is there, right? Combination of inherent risk and control risk. Now this 12 point risk of material misstatement, 12.5% risk of material misstatement, auditor has to reduce it to 2%, because his acceptable level of audit risk is 2% only. So what he will do, he will perform audit procedures. He will design his audit procedures in such a way that this 12.5% of risk of material misstatement comes down to 2%. That means his audit procedures should identify all the misstatements, so that the complete audit risk will remain as 2% only. Understanding? Now tell me, can the audit procedures identify all the misstatements? No, auditors procedures might also not be able to identify all the misstatements. So that concept, that auditors procedures might not be able to detect the misstatements, is known as detection risk. Understanding? Detection risk is the risk that auditors procedures cannot detect the misstatements. Now here, in order to reduce 12.5% Romum to 2.5%, how much detection risk he can accept? How much detection risk can he accept? So it becomes 2 divided by 12.5% is equal to multiplied by 100. Detection risk. That means, will it come around 16%? Roughly around 16% it will come. So that means auditors procedures should detect 84% of the misstatements that are there due to risk of material misstatement. That means 84% of the Romum has to be reduced by the auditors. 25% it will come. I guess it comes to 16%. 25%. Okay. So 2 divided by 12.5 into 100, 25%. That means audit procedures should detect, or auditor should perform his audit procedures in such a way that 12.5% Romum will be reduced to 2%. That means 75% of Romum should be reduced. Only balance 25% should remain. Understanding? So you can say that through this discussion, you can say that audit risk is a combination of inherent risk, control risk, and detection risk, or you can say that audit risk is a combination of risk of material misstatement, that is ROMM, multiplied by detection risk. Getting it? So clear with this concept? Any doubts? So the same thing I would have explained here, risk of material misstatements. So what is meant by misstatement? If there is a difference between ACPD that is required as per applicable financial reporting framework and ACPD that the management has followed for preparation of their financial statements, then you will call such a situation as a misstatement, right? What are the components of audit risk? Inherent risk, control risk, detection risk. I have given the definitions of all these inherent, control and detection risk, and you need to assess ROMM at two levels. What are those two levels? Assertion level and financial statement level. Assertion level means we have discussed various assertions. So at each of that assertion, how much ROMM is there, you need to calculate, and also for the complete financial statements, how much ROMM is there, you need to calculate. So ROMM has to be assessed at two levels, assertion level and financial statements level. Next, audit procedures. See, this audit procedures concept we will be seeing here in SA 330. Okay, while discussing SA 330, we will again have this concept of audit procedures. Okay, so at the time of discussion of SA 330, we will see that audit procedures concept. But as of now, we just remember that audit procedures broadly are of two types. One is risk assessment procedure and further audit procedures. So give me some of the examples for risk assessment procedures. Wrap. So inquiry. Inquiry means nothing but asking questions. Observation. Observation is also one of the risk assessment procedure, and inspection. So all these three are the risk assessment procedures. So by performing these procedures, what will you do? You will identify the risk. Correct or not? Yes. Next, what are the steps in identifying and assessing the risk of material misstatements? There are 4 steps in identifying and assessing the risk of material misstatements. Let's see what are those 4 steps. Firstly, you will identify the risk throughout your audit process. Understand? So in the entire audit process, you will keep on identifying how much risk is there in this area, how much risk is there in this area. Like this, you will keep on identifying the risks that are there in each and every area that you are going to audit. So once you have identified the risk, you will assess the identified risk. Assessing the identified risk means I have already told you. So is this risk isolated, or will it impact other areas also? Is it is this risk negligible, or is this risk very significant? This comes under assessing the risk. Next, now you have identified the risk. Next you have assessed that risk. Now you will relate the identified risk to what can go wrong at the assertion level. So because of the risk that you have identified, which type of misstatement can occur. Understanding? Next, consider the likelihood of misstatement. So how much chance is there that such a misstatement will occur? So these are the 4 steps that you will perform in risk assessment, risk identification and risk assessments. Balasa, please explain assertion level risk and financial level risk with example. I am a bit confused about that. Yeah, sure. So example for assertion risk at assertion level. So let's say for example, fixed asset. So one of the assertion for fixed asset is existence. Now there is a risk that even though the asset is not there with the entity, it might be showing that asset in the financial statements. So there is a risk with respect to this assertion of fixed asset. This you will call it as risk at assertion level. Understood the example for risk at assertion level? So for each assertion, how much risk is there? Next, risk at entire financial statements level, Romam at entire financial statements level. Let's say, for example, the accountant that the company is having, he is not that much knowledgeable. Okay, the accountant that the company has employed is not that much knowledgeable, and financial statements are prepared by that accountant only. Since that accountant is not having much knowledge about India's and accounting standards, there is a risk that many misstatements can be present in the financial statements. So this is Romam at the financial statements level. Understanding? If this accountant is highly knowledgeable, then the risk of material misstatements at the financial statements level will be less. So this is the example for risk of material misstatements at the entire financial statements level, and for Romam at the each assertion level. Understood? Understood, Bhaskar? Note: understanding the entity is a continuous and dynamic process, right? See, in order to identify the risk in the entity, or in order to identify the risk in a particular area, how will you identify the risk? By understanding that area, you will identify how much inherent risk is there in that area. Understanding? So if you observe, the name of SA-315 itself is that identifying and assessing the risk. How? By understanding the entity and its environment. Clear? So not only at the entity level, at each item level. So if you are going to audit area of sales and you wanted to know how much Romam is there in the area of sales, then you will understand that area of sales, how entity is generating sales, what type of sales are there, cash sales, credit sales, or entity is entering only into credit sales. So you will understand the area of sales. By that understanding, you will get to know how much risk is there in that area. Getting it? So risk assessment procedures performed to obtain understanding the entity and its environment. These include inquiries, analytical procedures, observation, and inspection. I have already given you the list. What is meant by analytical procedures? I'll explain you while discussing SA-313. I'll explain you. Basically, these analytical procedures, you can use them as both risk assessment procedures as well as further audit procedures. How you can use analytical procedures as risk assessment as well as further audit procedures, I'll be explaining while discussing in SA-330 in this class itself. Next, so by performing these risk assessment procedures, obtain an understanding of the following things. So as part of understanding the entity, what aspects of the entity you will understand? These aspects you will understand. In which industry the entity is operating? So industry means whether it is operating in mobile phone industry or car manufacturing industry or in FMCG industry. So what is the industry? Regulatory and other external factors including applicable financial reporting framework. You will also understand nature of entity. You will also understand entity selection and application of accounting policies, AS or Indias, and entities objectives and strategies and those related business risks. Objective means goals. So whether the goals of the entity are reasonable, and what strategies the entity is following for achieving that goals. Strategy means nothing but plans that the entity is following for achieving those goals. If the entity's goals are unreasonable, then the strategies that the entity will follow for achieving those goals will be not normal. Correct or not? So let's say, for example, in the current year, the turnover of the entity is 10 crore. In the next year, it has kept a goal of achieving 1000 crores. So here if you see, the objective or the goal is unreasonable. Now to achieve this goal, what the entity might do, it might show fake sales, This is one option. Or genuinely, okay, genuinely entity might strive to achieve this turnover. There are these two options available, but there is a risk that entity might employ this strategy of showing fake sales. Understanding? So you should also understand what are the objectives of entity and what strategies it is using to achieve those objectives. By understanding this, you will be able to identify if at all there is any risk in the entity. Next, measurement and review of entities financial performance. So how the entity's financial performance is being measured? Generally 99% of the cases, performance of the companies will be measured in the terms of profits. Correct or not? For some entities which are in the early stages, like startups, for them the performance measurement will not be profits, but the performance measurement for them will be like how many customers they have acquired, how many new customers they have acquired, how much turnover they are making. That can be performance measurement for some kind of entities. So how the performance of the entity is being measured, that also you need to understand. Why you need to understand that? Because if the performance of entity is measured based on profits, then entity might do some misstatements to achieve more profits, if at all its profits are less. Correct or not? So you should know how the performance of entity is measured, so that you will get to know whether there are any risks in that area. Understanding? Next, concept of significant risk. So what is meant by significant risk? Significant risk means you can say important risks that requires special considerations by the auditor. So significant risk means important risks that require special considerations by the auditor. When you can call a particular risk as a significant risk? If the likelihood of its occurrence is very high, the chance of that risk occurring is high, and if that risk occurs, the damage that it will create or the impact that it will create will be more, okay, higher magnitude of potential misstatements. If these two situations are there for a particular risk, you can call it as a significant risk. Understanding? Now, in order to determine whether a particular risk is significant risk or not, standard has given certain points. You need to consider these points in determining whether risk is a significant risk or not. So if the risk is risk of fraud, then there is a high chance that that risk might become significant risk. Next, whether the risk is related to recent significant economic accounting or other developments. Recent economic accounting other development means, example, ICAI has recently issued a new accounting standard or Indian accounting standard. There a difficult treatment has been given with respect to a particular item. Now, since that treatment is being followed for the first time, there is a high chance that entity might not be doing that accounting treatment properly. There can be misstatements in that accounting treatment which the entity might do. So there is a risk in that area, and that risk can become important risk, that is significant risk. Understood? Due to recent significant accounting developments, I have given example. Similarly, other developments and economic developments. Getting it? Next, complexity of transaction. So if a transaction is highly complex, then there can be the risk in that transaction can become significant risk. Next, whether the risk involves significant transaction with related parties. See, related party means there is a high chance that you might sell goods to the related parties at a lesser price, which might create loss to the company. So in case of related party transactions, there is a high chance of fraud occurring. So if at all there is any risk with respect to related party transactions, that risk can be treated as a significant risk. Next, degree of subjectivity in measurement of financial information. Subjectivity means emotions. So for measuring a particular item, high subjectivity is involved. Let's say, for example, provision for doubtful debts. Now in future, how much debts will become bad? How will you know? You cannot know. You will just do estimation, a subjective estimation you will do. So if high subjectivity is involved, then that risk might become a significant risk. If less subjectivity is involved, it might not be a significant risk. Yes, at the arm's length price you have to incur the related party transactions. Next, transactions that are outside the normal course of business. Outside the normal course of business means, see, generally entities products are selling cars. So its general business is to sell cars. Now suddenly in one particular year, entities was having a land, it has sold that land. Now this transaction of sale of land is a transaction which is outside the normal course of business. Understanding? Yes. Next, there are two types of risks which the standard will always treat them as a significant risk. What are they? Risk of fraud will always be treated as a significant risk, important risk, and also transaction with related party that are outside the normal course of business. This one will also be always treated as a significant risk, important risk. Getting it? Yes. Next, going to internal control system. What is meant by internal control system? So meaning of internal control system, internal control system is nothing but a process which is designed, implemented and maintained by whom? By those charged with governance, management and others. Why? To provide reasonable assurance about the achievement of entities objectives with regard to what? Reliability of financial reporting, effectiveness and efficiency of operations, safeguarding of assets, compliance with applicable laws and regulations. So to achieve these objectives, those processes which the management or those charged with governance will design, implement and maintain, such processes are known as internal control systems. So like this you can divide and remember this definition. Next, now tell me, is auditor having any responsibility to verify internal controls? Like he is having responsibility to verify financial statements and to give opinion on the financial statements. Just like that, is auditor having any responsibility to verify internal controls and to give opinion on the internal controls as part of statutory audit? The answer is no. There is no responsibility on the auditor to verify internal controls. Sir, then why auditor is verifying internal controls, sir? For the purpose of making his work of auditor easy. How the auditor's work will become easy, sir, if he verifies the internal controls? See, auditor wants to audit the area of sales. This example I have already told you. There are internal controls around the area of sales. Now, after verifying internal controls, auditor came to know that internal controls are operating effectively. Internal controls are operating effectively. If internal controls are operating effectively, it means that the chance of misstatements in sales will be less, romum will be less. If romum is less, he can perform less audit procedures. Correct or not? So for the purpose of designing his audit procedures, verification of internal controls will help the auditor. Understanding? Yes. So what are the benefits that you will get because of understanding internal control? You will be able to identify type of potential misstatements. Potential means probable misstatements. You will also able to identify factors that affect the ROMM and design the nature, timing, extent of further audit procedures. What is this further audit procedures? We will see in SA-330. Okay. Next. Now, can these internal controls detect all the misstatements? The answer is no. There are certain inherent limitations in the internal controls. So what are those inherent limitations that are there in the internal controls? See, they can provide only reasonable assurance because of human judgment in decision making. So some controls, they will be manual controls. Human beings will exercise the control. In such a situation, human beings are not robots, so every time they cannot be correct. So sometimes due to error, the control in the form of a human being that has been implemented over there can fail. That is one of the inherent limitation. Next, lack of understanding of the purpose. So if you implement a control without knowing the purpose for which it has been implemented, then there is no use of that control. Correct or not? Next, collusion among people. See, collusion among people can occur in case of segregation of duties. So you have segregated the duties among 4 or 5 people so as to avoid the fraud. Now all these people colluded, then the internal control has failed, right? Next, judgments by the management and limitations in case of small entities because they might be not having money. So all these are some of the limitations of internal controls, because of which controls cannot identify all the misstatements. Next, components of internal controls. So there are 5 components in the internal control. What are these components, sir? See, let's say for example, for a car to work properly, the components of car should work properly, right? Like engine should be in a working condition, wheels should be properly there, right? Steering should be there. So all these components of car should be working properly, only then car as a whole will work properly. Similarly, for the internal control system to be effective and to work properly, the components of the internal control system should be working properly. So what are those 5 components of internal control system? Firstly, control environment. So the environment in the organization should be in such a way that it is feasible for the internal control system to exist. So communication and enforcement of integrity, there is this particular point which goes like this. So there has been internal controls implemented in the organization, but the employees in the organization are number one fraudulent people. They are not at all having integrity. Then even though you have implemented internal controls, employees will find some way or the other to commit fraud and to override that internal controls. So promoting integrity in the organization is more important than the internal controls. If employees are highly integrity, having high integrity, then even though there are no internal controls, no frauds will take place. Understanding? So the environment in the organization should be in such a way that it promotes the integrity and participation by top level people, that is those started with governance, management philosophy and operating style. So how the management's philosophy is, if someone doesn't follow internal controls, is management punishing them or is management taking them lightly? That will also impact. Next, organizational structure, assignment of authority and responsibility. Authority and responsibility has to be given to same person. And human resource policies and practices, I told you employees should be having high integrity. So you should have the human resource policies in such a way that you are hiring highly you are hiring those employees who are having high integrity. Understood? Yes. Next, entities risk assessment process. See, here we are seeing entities risk assessment process. Entities risk assessment process is different from auditor's risk assessment process. Auditor will perform the risk assessment for the purpose of making his work of audit easy, but entity will perform the risk assessment for the purpose of designing internal controls. Only if entity comes to know how much risk is there in the area, entity will be able to properly design the internal controls. So for the system of internal control to be proper, entity should have performed proper risk assessment. Understanding? Yes. Next, control activity. Control activity is the actual control that has been established. There are various controls, segregation of duties, authorization, all these are controls. So that controls which have been established, actual controls, that should work properly for the entire system of internal control system to work properly. So some of such control activities are policies and procedures related to performance, information processing controls, physical controls, segregation of duties. These are just some of the examples. A lot of controls are there. All those control activities should be working properly. Next, information system and communication. See, for the purpose of implementing control in a particular area, you should first of all know how much risk is there in that area. So such information should be flowing from one department to other department properly. Only then you can implement the relevant controls, correct or not? So information system and communication. Information system means what? The system that provides you information, like let's say for example accounting software. Now accounting software will provide you financial information, so you can call this accounting software as a information system. It is providing you some information. So the information that has been obtained from the information system should be properly communicated, understanding? So this can be with related to class of transactions, how transactions are initiated, recorded, processed, and corrected, accounting records and supporting information, how information system captures the significant events, financial reporting process used to prepare financial statements, controls surrounding the journal entries, and finally, whatever the controls that have been established in the organization, that should be continuously monitored. Why monitoring is required? Let's say for example, you have established the internal control system and you have left it like that only. There are some loopholes, there are some lapses in the internal being issued. You need to update the existing internal controls. So for proper updation of internal controls, you have to continuously monitor them. If you don't monitor the internal controls, you cannot if you don't monitor the internal controls, you cannot update the internal controls. If internal controls are not updated, the complete system of internal control will not properly work. Got it? Any doubts over here? Next, now, are all the controls relevant for the purpose of audit? See, in the company there will be lot of controls that will be there, but auditor, he need not verify all the controls, only those controls that are relevant for the purpose of his audit, only those controls that will impact the financial statements, only such type of controls will be verified by the auditor, understanding? See, are all controls relevant to the audit? Firstly, controls over completeness and accuracy of information. So whether controls that are present over accuracy of information, are these controls relevant for the auditor? See, if auditor is using this information for the purpose of audit, then controls around this information will be verified by the auditor. Otherwise auditor will not verify, understanding? It depends on whether this information is used by the auditor for the purpose of his audit or not. See, relevant if auditor intends to make use of information in designing and performing further audit procedures. Next, internal controls over safeguarding assets. So auditor's consideration is generally limited to those relevant to the reliability of financial reporting. So if that internal controls that are operating around the safeguarding of fixed assets is necessary for the purpose of financial reporting, only then auditor will verify that controls, otherwise he will not verify. Next, generally these controls auditor will verify, understanding? Because the assets are forming part of balance sheet, correct or not? So controls that have been established for safeguarding of the assets are relevant for the purpose of audit, since assets are part of financial statements. Next, controls relating to objectives that are not relevant to the audit. Of course, if there are controls with respect to a area and that area is not relevant for the purpose of auditor, then of course auditor will not verify the controls around that area. Let's say for example, there are controls with respect to hiring of employees, HR policies. Now auditor has nothing to do with the HR policies of the entity, so auditor will not verify controls around that onboarding of the employees, understanding? Because it doesn't have any impact on the audit. Next, the conclusion is not all controls are relevant to the audit, only those controls that affect the financial reporting are relevant for the purpose of audit. Now there is a direct relationship between entities objectives and the controls it implements. So objective means goal. So if it wanted to achieve goals with respect to financial reporting, then it will implement controls around the financial reporting. If it wanted to achieve its goals related to operational activities means day to day business activities, then it will implement controls around that operational activities. Similarly, compliance with laws and regulations. So implementation of internal controls is directly related to what objectives the entity wanted to achieve. Next, now, for the purpose of verifying the internal controls, you need to obtain certain information from the you need to obtain certain information related to the internal controls. Now, how can you obtain information related to the internal controls? There are four methods for obtaining information related to the internal controls. What are the first one is narrative record. Narrative record means nothing simple. In your school days, you might have wrote a essay, right? Essay competitions. They would give a concept, and on that concept you need to write the essay. Here auditor in the entity, he will write a narrative record in the form of paragraphs about the internal controls that are there in the organization. Next, checklist. Checklist means, see, this checklist and internal control questionnaire, both of these will contain questions about the internal controls, but the difference is checklist will be performed or checklist will be answered by the audit staff, whereas internal control questionnaire will be answered by the management of the company or the employees of the company. Understanding? So that is the only difference between checklist and internal control questionnaire. Getting it? Yes. Next, flowchart. Flowchart means the one which we are seeing here is nothing but a flowchart. So if you prepare a flowchart with respect to how internal controls are there in the organization, that is a flowchart, right? Yes. So with the help of these four things, you will be able to obtain information about the internal controls. Next, going to materiality. So what is meant by materiality? What is meant by materiality? SA-320 deals with materiality, right? Now, what is meant by materiality? Generally, in case of audit, you will use this term materiality with respect to misstatements, whether the misstatement is material or immaterial, right? So, when will you call a misstatement as a material? When will you call a misstatement as material? Let's say, for example, in the financial statements, there is a misstatement. Now, if this misstatement is communicated to the user, then it will impact the economic decision that the user will take with respect to this entity. Then this misstatement will be treated as material. Understanding? So user wanted to invest in this company, and if you communicate to the user that user, in this financial statements there is this misstatement. Once user comes to know about that misstatement, user will change his decision of investing in the company. User will decide not to invest in the company. So because of that misstatement, the economic decision of the user has been changed. So such a misstatement you can call it as a material misstatement. Understand? So theoretically this is how you will define materiality. Sir, do we need to record methods used by auditor in evaluation of internal controls? Record means, are you asking that should documentation be maintained? Bhaskar, documentation has to be maintained. How you have verified internal controls? Relating to that, you have to maintain the documentation. Now, how will you calculate the materiality? What is the formula for materiality? Materiality is benchmark multiplied by a percentage. Now, What is meant by benchmark? I'll give you some of the examples of benchmark. You will only understand what is meant by benchmark. Sales of the entity can be called as benchmark. Net profit of the entity can be called as benchmark. Understanding? Or gross profit of the entity can be called as benchmark. So based on the type of entity, auditor has to select a particular benchmark. So if you say, in case of trading organizations, users will mostly focus on sales. So in case of trading organizations, auditor will take benchmark as sales. If let's say auditor is doing audit of a bank, in case of bank, users will focus on how many loans, how many fresh loans or how many total loans that the bank has given. On this figure users will focus more, because that will show the performance of the entity. So in case of banks, auditor might take total loans issued as a benchmark. So based on the type of entity, you will decide a benchmark. Let's say you have taken sales as benchmark. Let's say total sales is 1 crore rupees. Now on this sales, you will apply a percentage. How much percentage we should apply, sir? How will the auditor know how much percentage should be applied? Generally the percentage that you will select for calculating materiality will be single digit, like 2%, 3%, 4%, like that it will be there. Mostly single digit it will be there. Let's say 3%. Now how the auditor has arrived at this 3%, sir? How the auditor has arrived at this 3%? Based on his professional judgment. Okay, based on the underlying circumstances, auditor needs to arrive at a percentage. And if you calculate this, how much will be the materiality? 3 lakhs. So now auditor has calculated materiality as the 3 lakhs. That means auditor will be concerned with only those misstatements that are more than 3 lakhs. If there is a misstatement that is less than 3 lakhs, auditor will not be concerned. Now you can ask me a doubt, sir. Let's say for example, auditor has identified a misstatement of 2,50,000 rupees. This is less than materiality level only, but only 50,000 is less, sir. Once he identifies another 50,000 misstatement, it might reach materiality level. Now, will auditor leave this 2,50,000 materiality as it is without correcting it? The answer is, to solve this problem, there is concept of performance materiality. Performance materiality. Now what this performance materiality says? First of all, how to calculate performance materiality? It is the materiality multiplied by a percentage. Materiality you have already determined in our example. How much is the materiality? 3 lakhs, right? Multiplied by percentage. Now the percentage that you choose for performance materiality, it will be very huge. Most of the times it will be more than 70%, like 75%, 80%, 90% it will go. Okay, so let's say he has chosen 80%. What happened? Just a second, this pen is not working. What happened to the pen? Oh my god, pen is not working. Just a second. Yeah, now it's working. Fine. Sorry. So generally the percentage that the auditor chooses for performance materiality will be somewhere around more than 70%. Let's say he has chosen 80%. Now 3 lakhs multiplied by 80% means 2 lakh 40,000, right? So materiality is 3 lakhs and performance materiality is 2,40,000. What is the implication of performance materiality? What is the significance of performance materiality? The significance of performance materiality is that once the misstatements reaches the performance materiality level, auditor becomes alert. Auditor will ask the management to correct that misstatement. Why? Because there is a possibility that identified misstatements plus unidentified misstatements unidentified misstatements, if you combine both these misstatements together, they might cross materiality. Together they might cross 3 lakh, even though the identified misstatement here is 2,50,000 only. We have discussed already, audit procedures cannot identify all the misstatements, so there can be some unidentified misstatements also. So if you combine that unidentified misstatements with identified misstatements, it might cross the materiality level of 3 lakhs. To avoid such a situation, auditor will keep this concept of performance materiality, wherein once the misstatement reaches performance materiality, auditor becomes alert and asks the management to correct those misstatements. Understood? So this is the concept of materiality and performance materiality. Any doubt with respect to this? I guess there is no doubt with respect to this. Yeah. So if you see whatever I have discussed, the same things you will find here. Materiality can be determined at financial statements level and transaction or account balance level. Another important point, this materiality that you have determined, it is not that for all the items the same materiality level should be fixed. For the sales you can determine one materiality, for purchases other materiality level, for assets some other materiality level. Like this, item wise you can have different materiality level, understanding? And you need to document the material levels for particular classes of transactions and performance materiality. So how you have arrived at all these things, you need to document that. Next, what is meant by materiality? The definition I have given: misstatements are considered to be material if they individually or in aggregate influence economic decisions of users. And of course, materiality is a matter of professional judgment. Why materiality is a matter of professional judgment? Because how much percentage has to be applied on the benchmark, based on professional judgment you have decided that percentage. So materiality as a whole is a matter of professional judgment. And determination of materiality is responsibility of auditor. Of course, management will not determine the materiality, and materiality is to be applied both in the planning as well as the performing stage of the audit. Now, while exercising this professional judgment for calculating the materiality, auditor will take certain assumptions about the users. What assumptions auditor will take about the users? The following assumptions. So auditor will assume that users have a reasonable knowledge of the business. So users of the entity, they already know what business the entity is doing. So this knowledge users have, like this the auditor will assume. Auditor will not try to explain about the business nature of the entity to the users, and understand that financial statements are prepared and audited only to the levels of materiality. Auditor will also assume that users know that audit will not provide absolute assurance. Auditor has conducted the audit only till the level of materiality. Just a second, I'll read your comment after these 2 points. Recognize the uncertainties in inherent recognize the uncertainties inherent in the measurement of amounts. So I told you an example: provision for doubtful debts. You are making that provision based on estimation. So whatever the provision that you have made, it is not that actual bad debts also same amount will occur. There can be uncertainty between the provision you made and the actual amount that will happen. So users already know about this uncertainty. Like this, the auditor will assume, and auditor will also assume that users can make a reasonable economic decisions. So auditor can take all these assumptions about the users. Now going to the comment section. Correct me if I am wrong, sir. Performance materiality fix to reduce audit sample risk. Audit sample risk. And you can say that also. performance, you are saying it in a narrow way, I'm saying it in a broad way. Okay, so performance materiality, you are fixing it so as to reduce the chance of identified misstatements combined with unidentified misstatements crossing materiality level. Now sample risk means what? The risk that the sample, because of use of sample, you might not be able to identify some misstatements, correct? So yes, you can say that also, but that is very narrow way of saying it. Okay, Bhaskar, you can say that performance materiality is fixed to reduce audit sampling risk, but that is a very narrow way of saying risk, uh, very narrow way of saying it. Okay, next, how to calculate materiality? Of course, benchmark multiplied by percentage involves exercise of professional judgment for determining the percentage. Now while determining the benchmark, what factors you will consider? There are 5 factors. This is very much important. Okay, there are 5 factors that you will consider in determining the benchmark. So benchmark will be selected from items of the financial statements, either sales, gross profit, net profit, you will select as benchmark. So you will first of all see what elements are there in the financial statements. Elements means nothing but that only items, sales, purchases, all those they come under elements. Next, items on which attention of user tends to be focused. So I told you, in case of trading organization, users focus on sales. In case of, let's say, banks, users focus on how many loans has been granted. So while selecting the benchmark, you should also see, is there any item in this organization on which users tend to focus more? That also you should consider. Next, what is the nature of entity, ownership structure of entity, and volatility of benchmark? See, the benchmark that you select should be less volatile. Volatile means fluctuations. There should be less fluctuations. Let's say, for example, in the current year, sales of the entity is 10 crore. In the next year, it is 100 crore. Again, in the third year, it has become 1 crore. That means there is huge volatility in the sales figure. You should not select such a kind of item as benchmark. Understanding? Yes. Next, performance materiality. Amounts set by the auditor at less than materiality to reduce to an appropriately low level the probability that aggregate of uncorrected and undetected misstatements exceeds the materiality level. The definition of performance materiality. And you should always remember that performance materiality will always be less than materiality level. Okay. So that is about SA 320. We are done with SA 320. Next, moving to SA 265. So SA 265 deals with communicating deficiencies in internal control to those charged with governance and management. Now, why we are discussing SA 265 along with these standards only? Because if you see in SA 315, auditor has verified internal controls, correct or not? As part of verification of internal controls, if at all auditor has identified any deficiencies in the internal controls, auditor can communicate those deficiencies to those charged with governance as per SA 265. Understanding? So that's the reason why we are covering SA 265 here along with SA 315. Okay, yes. So now what is meant by deficiency in the internal control? In 2 situations you will call that there is a deficiency in the internal control. So first situation, control is unable to prevent or detect and correct the misstatement. So there is a control that is present, but that control is not able to detect, prevent, correct the misstatements. Then you will call that there is a deficiency in the control. Next, the required control is not at all there, then also you will call that there is a deficiency in the control. Understanding? No issues. I am used to this continuous teaching. You need not worry about that. Okay? Okay, Bhaskar? I'm completely fine with teaching for continuous hours. Okay? But thank you for the concern. Next, communication process. Now, how will you communicate the deficiencies that you have identified with those charged with governance? How will you communicate with those charged with governance? See, first of all, you will determine whether there are any deficiencies in the internal controls. After determining whether there are any deficiencies in internal control, you will check whether that deficiency is a significant deficiency, because you will communicate only significant deficiencies with those charged with governance. You will not communicate all the deficiencies with those charged with governance. Understanding? Now, when can you call a deficiency as a significant deficiency? See, auditor has identified a deficiency in the internal control, and auditor, in his professional judgment, he feels that this deficiency has to be brought to the notice of those charged with governance. Then it will be deemed that such a deficiency is a significant deficiency. Understanding? Those deficiencies which in the auditor professional judgment he feels that they have to be brought to the notice of those charged with governance, such deficiencies will be termed as significant deficiencies. Clear? So he will see whether there are any significant deficiencies. If at all there are any significant deficiencies, he will communicate in writing significant deficiencies to those charged with governance on a timely basis. Now, what is meant by a timely basis? Again, timely basis, auditor needs to determine it based on his PJ, that is based on his professional judgment. Understanding? Let's say, for example, in a period of 1 week, auditor has identified only one deficiency. Now, that single deficiency, you will not communicate it to those charged with governance immediately. You will wait for 1 more week to identify some more deficiencies and you will communicate. Let's say in the first 2 days itself, you have identified 30 deficiencies. Now, immediately you will communicate these deficiencies to those charged with governance within that just 2 days. So, what is meant by timely basis? That depends on the professional judgment of the auditor. You need to decide based on the circumstances. Getting it? Next. So, significant deficiency means deficiency or combination of deficiency in internal control that in the auditor's professional judgment is of sufficient importance to merit the attention of those charged with governance. Now, in deciding whether deficiency is a significant deficiency or not, standard has given certain factors. It is saying, auditor, you consider these factors in determining whether a deficiency in internal control can become significant deficiency or not. Okay. So, what are those factors? Let us see. Firstly, likelihood of deficiencies leading to material misstatement. So, there is this internal control and there is this deficiency in the internal control. Because of this deficiency, the chance of material misstatements is high. Then there is a chance that this deficiency can be treated as a significant deficiency in the internal control. Understanding? Yes. Next, susceptibility to loss or fraud. So, because of this deficiency, there is a high chance that fraud can occur. Then also, such a deficiency in the internal control can be termed as a significant deficiency. Next, subjectivity and complexity of determining estimated amounts. So, there is a high amount of subjectivities involved in estimating a particular amount, and around that amount there are controls and there is deficiency in the controls. In such a situation, you can call such a deficiency as a significant deficiency, because the amounts that are subjected to that internal control involves lot of estimation and subjectivity. Understanding? Next, financial statement amounts exposed to deficiency. You should also see which type of amounts are exposed to deficiency in the internal control. Let's say if in the area of sales, around sales, there is a deficiency in the internal control, then this can be termed as significant deficiency. Similarly, in the area of rent, there are controls around expenditure of rent, there are controls, and there is a deficiency in this controls. Now when compared to deficiency in controls around rent, deficiency in controls around the area of sales is more important. Correct or not? Because sales number will be huge, huge amount sales. Rent monthly once you will pay. Correct or not? So the probability of this deficiency coming as significant deficiency is more when compared to this. So here you will treat this type of deficiency as significant deficiency in internal control. So you should also see which type of amounts are exposed to that deficiency and what is the volume of activity in that amounts. Of course, volume of sales activity will be more when compared to volume of rental expenditure, right? Next, interaction of deficiency with other deficiencies. So there is a possibility that there is one deficiency in the internal control which is not significant, and there is also another deficiency in the internal control which is not significant. Individually they are not significant, but if they combine, the combined effect might give a significant deficiency in the internal control. So you should also see that whether two or more deficiencies combining and becoming significant deficiencies. Understanding? Yes. So all these factors you need to consider in determining whether deficiency in internal control can become significant deficiency or not. Next, contents of written communication. Now once you have identified the significant deficiencies, what will you do? You will communicate these significant deficiencies to those charged with governance, right? In a written format you will communicate. Now what should be the content of that communication to those charged with governance? So you will describe the deficiencies. See, it is not sufficient if you just say to those charged with governance that there is a deficiency in that control. No, you have to describe what type of deficiency is there, because of that deficiency which amount will get impacted, how it is deficient. You need to give a clear description of the deficiency, and you should also give information that will give a context, that will build up a context to the management or those charged with governance about that deficiency. See, sufficient information has to be provided to enable those charged with governance and management to understand the context, and you should also explain in your written communication that purpose of your audit was to express opinion on financial statements, because there is a chance that those charged with governance might think that auditor is having a responsibility to verify all the internal controls and bring to the notice of those charged with governance deficiencies in all the internal controls, but auditor is not having such a duty now. So auditor has to clearly mention, my purpose is to do audit of financial statements, and audit included consideration of internal control relevant to financial statements. As part of audit, for the purpose of making my work of audit, I have verified some of the internal controls, and matters being reported are limited to those deficiencies that the auditor has identified during the audit. Okay, so as a part of audit, I have verified some internal controls. As a part of such verification, if at all I have identified some deficiencies, I'm communicating that deficiencies to you. You don't think that I will bring to the notice of you all the deficiencies in the internal controls. There might be some deficiencies which I might have noticed. Okay, so you have to clearly communicate this to those charged with governance in your written communication. Understanding? Yes. Next, internal financial controls. So what is meant by internal financial controls? Controls that are established around the financial reporting process, around the assets, safeguarding of assets. All these they come under internal financial control. See, policies and procedures put in place for ensuring reliability of financial reporting. What is meant by financial reporting? The process of preparation of books of accounts and preparation of financial statements. Out of that books of accounts, it comes under financial reporting. Next, effectiveness and efficiency of operations, compliance with applicable laws and regulations, safeguarding of assets, prevention and detection of frauds. So the controls that have been established to achieve these purposes, you will call them as the internal financial controls. Yes, we have to provide context of communication to those charged with governance. Next, going to SA 330, auditors responses to assessed risk. What is meant by responses? Responses is nothing but the audit procedures that the auditor is performing, or known as responses. To what auditor is responding? Auditor is responding to the ROMM that he has identified as per SA 315. Understanding? Yes. So this deals with auditor's responsibility to design and implement responses to risk of material misstatement. Next, matters to be considered in determining extent of test of controls. So now let me tell you about audit procedures. These audit procedures, they are of risk assessment procedures, RAP, which we have discussed in SA 315, and they are of FAP, further audit procedures. This further audit procedures we will be discussing here in SA 330. Okay. Now these further audit procedures, you can again classify them into test of controls and substantive procedures. Substantive procedures. Now, what is meant by test of controls? Those audit procedures that you will perform on the controls, about whether controls are operating effectively or not, whether they have been designed properly or not. So the tests or the audit procedures that you perform over controls are known as a test of controls. Next, coming to substantive procedures. Substantive procedures means nothing but the detailed procedures that you perform. So these substantive procedures, they can be again bifurcated into test of details and substantive analytical procedures. Now, what is meant by test of details? You can say test of transactions and test of balances. Test of transactions means nothing but vouching. Vouching that you perform is nothing but a test of transaction. So this is a detailed verification. Transaction by transaction you will verify. And a test of balances means nothing but a verification with respect to assets you will verify na. That is, verification comes under test of balances. Getting it? So test of details means detailed verification of the items. Now we need to understand substantive analytical procedure. Basically there is a separate standard, SA-520, which deals with analytical procedures. There also we will be discussing about analytical procedures, but here I will just tell you how you can use analytical procedures as both further audit procedures and also risk assessment procedures. If you remember, analytical procedure, you can use it as a risk assessment procedure also, right? So how you can use? First of all, I will tell you how you can use analytical procedure as a risk assessment procedure. So let's say, for example, in the previous year, the gross profit of the entity is some 25%. Okay, for the past 5 years, it is that much only, 20 to 25%. It is varying for the past 5 years. But in the current year, gross profit has become 80%, anonymous increase in the gross profit. Now, here, if you compare the trend of gross profit, the trend of gross profit is 20 to 25% till previous year. Current year, suddenly it increased. So, trend analysis is nothing but a analytical procedure. One of the analytical procedure is the trend analysis, which you will be seeing in SA-520. Now, by using this trend analysis, you are able to identify certain risk. So if gross profit has increased this much, means there is a possibility that they might have increased they might have booked the fake sales, or they might have shown fake closing stock so as to achieve this much gross profit. See, I am just saying risk. It is not that for sure they have booked fake sales. There is a risk. Might be genuinely also their gross profit might have increased. Understanding? But there is a risk. This risk you are able to identify by performing analytical procedure. Understanding? So this is how you can use analytical procedure as risk assessment procedure. Now, how you can use analytical procedure as a substantive procedure, that is further audit procedure. Let's say, for example, in the P&L statement, salaries expenditure has been shown as 1.2 crore, right? Yes. Now, one way to verify this salaries expenditure is month wise. You will take bank statement and payment vouchers that are signed by the employees for taking salary. Each salary by salary you can verify. That you will call it as vouching. That is one option to verify salaries. Another option is analytical procedure. How? You will ask the management, how many number of employees are there in your organization? Management will say 100 employees. Okay, how much average salary you are paying to them? Management will say on an average we are paying 10,000 per month, multiplied by 12 months. It becomes 1.2 crore. So you haven't verified each transaction by transaction. By just doing this calculation, you have verified the salary expenditure that is present in the P&L item. So this is nothing but a analytical procedure that you have performed. Understanding? Clear? So this way you can use, here you have used analytical procedure as a substantive procedure. Getting it? So this way you can use analytical procedure as both risk assessment procedure as well as substantive procedure. So see, now matters to be considered in determining extent of test of controls. That means how much test of controls you have to perform. In making that decision, how will you, what matters you consider? Comparing financial information with non-financial information. That is nothing but analytical procedure. Definition of analytical procedure. See, frequency of performance of control. So how frequently you are performing the control, you need to take that point into consideration while determining extent of test of control. Extent means what? Extent means how much quantity of audit procedures you have to perform for the purpose of verifying the controls. For knowing that, you should first of all check how frequently that control is being used by the management. If the management is using that control quite frequently, then more audit procedures you have to perform on that control, to check whether that control is working properly or not. Next, length of time during the audit period auditor is relying on that control. See, if auditor is relying on that control for his entire audit, okay, for the entire financial year auditor is relying on that control, then of course he has to perform more audit procedures on that control. If auditor is relying on that control only for one day, let's say for example, controls over conduct of physical verification of inventory. Physical verification of inventory will be conducted only as on 31st March. So controls around that area will be relied by the auditor only for that day. Whereas controls over sales will happen throughout the year. So controls over sales are being relied by the auditor for throughout the year. So for verifying the controls over sales, auditor has to perform more audit procedures. Whereas for verifying controls over physical inventory verification, auditor can perform less audit procedures, less test of controls. Understanding? Yes. Next, expected rate of deviation. So expected rate of deviation means how much chance that control is not working properly is known as deviation. So if such deviation, expected rate of deviation is more, then auditor has to perform more test of controls. If expected rate of deviation is less, auditor will perform less test of controls. Next, relevance and reliability of audit evidence. What is meant by relevance and reliability of audit evidence? We will be discussing in SA-500. Relevance means how relevant that is for the purpose of our purpose. Okay, we will be seeing it in SA-500. Okay, there I will be explaining you. And reliability means how much you are able to believe on it. So if relevance and reliability of audit evidence is more, then you can perform less test of controls over that control. Next, extent to which audit evidence is obtained from test of other control. So all these factors or all these matters you need to consider in determining whether in determining how much test of controls has to be applied. Understanding? Yes. Next, nature and extent of test of control. So what type of test of controls you have to perform? See, you can perform other audit procedures in combination with inquiry. Determine whether controls to be tested depend upon other controls. If a control that you are testing is dependent on other control, then you have to verify that other control also. It is not sufficient if you just to verify this control, because this control is dependent on such other control. You can take example as general IT control and application control. Application controls are dependent on the general IT controls, right? About that concept we will be seeing in audit in an automated environment. Next, inquiry combined with inspection or re-performance. So it is suggestible to do inquiry along with re-performance or along with inspection, instead of doing inquiry along with observation. Why, sir? Why first one is more preferable than the second one? See, by inquiring you will get some answers. By posing some questions you will get answers. That answers which you have got, you will verify them through re-performance and inspection. So you have asked whether controls are working properly, segregation of duties is there properly or not. You have asked. They told that yes, segregation of duties is there. Even authorization of transactions is also there. Authorization means for making any purchases, higher officer approval is required. That is known as authorization, which is an internal control. So employees told that yes, authorization is there. This control we are following. Now the answer to inquiry you got, that authorization control is there. Now you have to verify it. How you will verify? You will inspect the documents, purchase invoices you will inspect. So you can inspect previous purchase invoices also. That means past purchases invoices also you will verify to check whether on the invoices approval authorization is there or not, correct or not. Whereas if you perform inquiry along with observation, observation means past activity you cannot observe, only ongoing present can be observed, correct or not. So if you perform inquiry along with observation, you will get evidence only about the present ongoing activity. With respect to past, you cannot get evidence. But if you perform inquiry along with reperformance or inspection, you will get evidence about the past transactions and the current ongoing transactions also. Getting it? So it is preferable to perform inquiry along with reperformance or inspection, and the nature of that particular control. So all these things you need to consider. Next, audit procedures. The list of audit procedures, I have already explained you this concept, right? Just now I have explained you. Next, in designing further audit procedures, what considerations auditor needs to take into account? So while designing further audit procedures, you will design your further audit procedures based on the ROMM that you have identified in the risk assessment procedures, correct or not? So first thing that you will consider is reasons for the assessment of for the assessment given to the ROMM as part of risk assessment procedures. Next, likelihood of misstatement. So what is the chance of such a misstatement occurring? That also you will consider for designing your further audit procedures. Next, relevant controls. So if controls are working properly, less audit procedures, less further audit procedures. Controls are not working, more further audit procedures. Next, more persuasive audit evidence, the higher the auditor's assessment of risk. Persuasive means, see, there are two terms. One is pervasive, another one is persuasive. Pervasive means this term we will be seeing in SA-705, right? Misstatements present across, spread across. So pervasive means present in many areas is known as pervasive. Persuasive means more believable, right? So this is the difference between pervasive and persuasive. So if the ROMM is high, the type of audit evidence that the auditor obtains should be more persuasive, more believable. Understanding? Yes. Next, timing of test of controls, particular time or throughout the period for which auditor intends to rely on those controls. So whether auditor should test the control throughout the period or at a point of time, it depends on the auditor. If auditor wants to rely on the control for entire period, he will test the control for entire period. He wanted to rely on the control only for particular point of time, he will test for that particular point of time. Understanding? Yes, sir. Next, specific inquiries by auditor when deviations from control are detected. So auditor has performed some audit procedures and auditor has identified that there are some deviations in the controls. So once you identify the deviations, what are specific inquiries that you need to make? See, test of controls provide appropriate basis for the reliance on controls. Whatever the test of controls that I have performed, are they sufficient? Are they appropriate for providing me information about the test of controls, or should I perform more test of controls? You need to once inquire yourself about that. Next, any additional test of controls are necessary, and potential ROMM need to be addressed using a substantive procedure. So if you feel that just performing test of controls is not sufficient, you can use substantive procedures also to address the risk of material misstatement. Understood? Next, using audit evidence obtained in the previous audits. Now, controls you have already verified in the previous year audit. The same controls are there now also. Can you rely on the test of controls that you have already performed in the previous year, or you should perform test of controls again afresh in the current year? That depends on what aspects it depends. See, effectiveness of other elements of internal control. So if all the elements of internal controls are working properly, you can rely on the same test of controls that you have performed earlier. Risk arising from characteristic of control, effectiveness of generality controls and application controls we will be seeing in audit in an automated environment. Next, whether lack of change in a particular control poses risk, and what is the ROMM? Establish continuing relevance of that evidence. So all these things you need to consider in deciding whether to use same procedures, or whether to rely on the internal, on the test of controls that you have performed previously, or should you perform test of controls again in the current year? Also there is a doubt. Sir, in the examination, if question asked list down audit procedures, whether we have to write risk assessment and further audit procedures, or we have to write inquiry. See, both you need to write. If in the examination they asked you list down audit procedures, you should say that audit procedures are of two types: risk assessment procedures, further audit procedures. Risk assessment procedures or inquiry, analytical procedures, inspection, observation. And further audit procedures, we can divide them into test of controls, substantive procedures. Substantive procedures, we can divide them into, okay, test of details. All you have to write. And you should also give some of the examples for audit procedures, like inquiry, inspection, reperformance, recalculation. All that list of procedures also you have to write. Okay, better to write the complete explanation. Understanding, Bhaskar? Next, SA 450, which is the final standard. So it will hardly take another 10 minutes to complete this standard. We'll be completing this particular chapter. So, evaluation of misstatements identified during the audit. So, as per SA 315, you have identified Roman risk of material misstatement, and for that risk of material misstatement, you have given your responses as per SA 330, and you have identified some actual misstatements. Now, evaluation of these misstatements comes under SA 450. How will you evaluate these misstatements? Before that, see, what is meant by misstatement? We have already discussed it a lot of times. Yes. Next, misstatements, they are of different types. Okay. Misstatements, they are of different types. What are those types of? Firstly, identified misstatements. Auditor has identified misstatements and unidentified misstatements. Once you have identified the misstatements, what will you do? You will communicate those misstatements to the management, and you will ask the management, please correct these misstatements, right? So management will correct some of the misstatements. So corrected misstatements, here you can write either identified misstatements or detected misstatements, unidentified misstatements or undetected misstatements. Okay, so after identifying the misstatements, you will communicate to the management, and they will correct some of the misstatements, that is corrected misstatements. And some misstatements they will not correct, uncorrected misstatements, right? And unidentified misstatements, since they are not at all identified, they will remain uncorrected, correct? So these are some types of misstatements. Still there are some more types of misstatements, we'll see. So uncorrected misstatements, I have told you. Factual misstatements. Factual misstatement means by fact it is misstatement. No one can question, 100% sure, guarantee it is misstatement only. No one can argue about it. That is known as factual misstatement. Next, judgmental misstatement. Judgmental misstatement means misstatement arising because of a judgment. That means you have made a provision for doubtful debts of rupees 20 lakhs provision you have made. Now judgment will be involved for making this provision, right? Now actual bad debts occurred is 25 lakhs. Now there is a difference of 5 lakhs between actual and provision. So this type of misstatement will be known as judgmental misstatement. So this misstatement has occurred because of the judgment. Understanding? Yes. Next, projected misstatement. What is meant by projected misstatement? Projected misstatement means in case of sampling this will occur. So there is a 1,000 population, you cannot audit complete 1,000 population. You have taken 100 sample and you have performed audit procedures on 100. You have identified one misstatement in the 100 sample. Now you will project these misstatements to population. That means in 100 sample one misstatement is there, means in 1,000 population how many misstatements will be there? 10. So this becomes projected misstatements. Understanding? You have projected the misstatements to population based on the misstatements that you have identified in the sample. Clear? Yes sir, clear sir. Next, clearly trivial misstatement. Trivial means negligible misstatement, insignificant misstatement. Like while you prepare financial statements, if at all there are any decimals, you will round off them, right? Now because of such a rounding off between assets and liabilities, there is a difference of some 1 or 2 rupees. This is a rounding off error. Now this rounding off error, because of this rounding off error, will you give modified opinion in your audit report? No, right? You will generally ignore these type of misstatements. So that is known as clearly trivial misstatement, which is of wholly a different magnitude. Okay, so smaller order of magnitude than materiality determined and will be matters that are clearly inconsequential. Understanding? Yes. Next, consideration of identified misstatements as the audit progresses. So while you keep on doing the audit, you will identify new misstatements, right? So as you keep on identifying new misstatements, how will you take forward those misstatements? See, identified misstatements indicate that other misstatements may exist, or aggregate of misstatements approach materiality. So the new misstatements that you are identifying makes you feel that some more misstatements might be there, or the misstatements that you are identifying are reaching or crossing materiality level. Then determine whether overall audit strategy and audit plan to be revised. Should I perform more audit procedures, because I am feeling that more misstatements might be there? To identify that additional misstatements, should I include additional audit procedures in my strategy and plan? Should I revise my audit strategy and plan, or should I keep my audit strategy and plan as it is only? You need to consider that. Understanding? Yes. Next, the misstatements that have been identified during the audit, you need to communicate with management on a timely basis and request the management to please correct those misstatements. If management refuses to correct those misstatements, understand the reasons. You should ask the management why you are not correcting those misstatements, and consider while forming the opinion. Got it? Yes. Next, evaluating the effect of uncorrected misstatements. So you have told the management that management, these misstatements are there, please correct them. Management has not corrected the misstatements. Now how will you consider these uncorrected misstatements for the purpose of your audit? So you will once reassess materiality. So the materiality level that I have kept initially, will it be valid now also, or should I revise my materiality level because of these uncorrected misstatements? And in determining materiality of uncorrected misstatements, auditor shall consider size and nature of misstatements. What is the nature of misstatement and what is the size of that misstatement? Circumstances of their occurrence and effect of uncorrected misstatements. That means because of uncorrected misstatements, what impact it will have on the financials, and what type of opinion I have to give. The impact on my opinion I need to consider. Okay. Next, finally, you will communicate with those charged with governance. So you will tell to those charged with governance, see, those charged with governance, these misstatements we have identified and told to the management, but management, they have not corrected these misstatements. So uncorrected misstatements and their effect, you will communicate to those charged with governance, hoping that at least those charged with governance might correct them. And effect of uncorrected misstatements related to prior periods. If at all there are any uncorrected misstatements in the prior period, what effect that misstatements will have for the current period, that also you will communicate with those charged with governance, and request them that uncorrected misstatements be please corrected. Like this, you will request those charged with governance. So that is complete discussion of SA 450. So clear with today's discussion? Any doubts in the today's discussion? No doubts, right? No doubts, I guess. So shall we wind up today's session? Yes, Jai Balaya. Shall we wind up today's session? Yeah. So I'll be winding up today's class. Most probably tomorrow there might not be a live session. I'll intimate you. Day after tomorrow, for sure it will be there. Tomorrow I'll intimate you. Okay. Yes. So I'll be winding up this class as of now. We'll meet you in the next class. Until then, take care. Bye bye. See you.